holders, issue number 2, the payments for ownership interests which are part of consideration or for post-combination employment. Now, there is a delicate line here, like these options, are they paid as a consideration of the transaction? If that is the case, then they would become part of the whole goodwill calculation. If they're not given as a consideration for the past, for that transaction, but it is given as a incentive for the future management service, then it would not be taken into the goodwill calculation, and then it would be taken as a normal share option given to employees. So payments for employment expensed in income statement, as I said. Earns out and contingent consideration. Contingent consideration recognize whether probable or not. As long as contingent consideration is contained into the merger documents in the legal form, it has to be recognized whether it is probable or not. Liabilities remeasured through income statement, equity not remeasured, and I'll explain in the next slide. So as a rule, as I said, that at the date of combination, we will fix all the values. So if these are the liabilities, these would be remeasured definitely in the future dates. So any differential coming would go to P&L. But if these are equity instruments, these would not go to P&L. We'll see that. Transaction costs not transferred to seller for the acquired business, so expensed out. Earnout payable, earnout could be in two forms: earnout payable in cash, earnout payable in ordinary shares. So if it is cash, then we all know it's a liability and it should be remeasured at fair value at every balance sheet. If it is in ordinary shares, it may not require remeasurement through the income statement. Why? Where the number of shares varies to give the recipient of the shares a fixed value would meet the definition of a financial liability. As a result, the liability will need to be fair valued through income. So if we have fixed an amount, let's say 1 million rupees, and we will give equivalent number of shares in 1 year's time. So the settlement would be in the form of shares, but because the amount is fixed, so it is not an equity transaction, it is a liability transaction, and remeasure means the amount remains fixed. But when the number of shares is fixed and the amount is not fixed, in that case it would be considered as an equity transaction, and then it would not be remeasured through the income statement. Okay, the goodwill concept is that goodwill amount is frozen on combination. I'll tell you the frozen, what does it mean, because there is a window of time available before it gets frozen actually. So that will follow. But once determined on the date of combination, when all the areas have been considered and the amount of goodwill has been determined, we can't really touch that again. And that amount would appear there. The only thing is the impairment testing. We all know that, and we will test for impairment every year. Measure NCI at fair value, non-controlling interest, previously minority interest, that would also be valued at fair value. There are two options: either we recognize full goodwill and we take the NCI share also into that, or we just recognize our portion of goodwill. Because the way that this combination is that we are actually looking at the whole business, and the whole business is actually 100% equity. And in that whole business, if I'm holding 80% and 20% is minority interest, non-controlling interest, it doesn't matter, it shouldn't matter how much holding I have, as long as I have control, whether I have 51% holding or 100% or 99% holding, it doesn't affect anything. So the idea is that goodwill should be measured in that context. So the full goodwill means that I take into account the minority interest share also, and I value everything, the whole business, give a value and determine goodwill at that level, which would be obviously higher amount of goodwill, which would include the share of goodwill of minority interest. But the standard allows us to recognize goodwill for the proportionate share of the controlling entity. So if I'm only holding 80% of the interest, then I can recognize 80% of the goodwill at the date of combination. Policy choice, NCI at fair value or share of net assets. I just explained full goodwill, increased net asset and equity, increased future impairment charge, less effect on net assets equity from future purchase of NCI. Now, obviously the amount of goodwill would be higher in this case, so the impairment charge would be higher. But the good side is that whenever there is a movement between the shareholdings and between the controlling interest holder and the minority interest holder, there is no implication on the goodwill. So if I hold 80% shares, I hold control also, and the minority is 20%, I acquire another 10% from minority. This is a transaction between the two equity holders. It would not affect any treatments. But if it is partial goodwill, then yes, it would affect goodwill. Frequency of impairment does not change, only amount. So we will still apply the impairment test every year. Okay, these are two handouts, handout 2 and handout 3, which are there. These are, I'll not go through it because I have another important handout, handout 4, which would follow. These you can refer to later on. These just give you guidelines as to when there is a proportionate method used, how we need to assess as to how the impairment testing would be done. And when there is, the handout 4 is for, sorry, handout 2 is for the fair value method, when the full value has been recognized as goodwill. So how it would be assessed. And the handout 3 is when the proportionate method is chosen, how it would be assessed. And when there is a less than 100% combination. That you can refer to later on. Assets and liabilities recognize what has been acquired. Almost all assets, liabilities, contingent liabilities recognized and measured at fair value, with exceptions for certain items, for example, deferred tax and pension liabilities. So essentially, we will recognize everything at fair value. The only exceptions are there actually. The exceptions are things falling under IAS 12, under IAS 19, then IFRS 2, as I discussed, share options, the standard would be followed. For assets which have been held for disposal, which fall under IFRS 5, for them, they would not be fair valued, but they would be valued according to IFRS 5. So these are some of the exceptions, but other than these, the standard elaborates on these exceptions in detail, so that can be referred later on. No major changes to current IFRS 3 otherwise. More guidance on assessing contracts, and intangible assets must always be recognized and measured. There is no reliable measurement exception. Previously, for intangible assets, if they were reliably measurable, then only it was required to be valued and recognized. But if they were not reliably measurable, then you could have just ignored them. But now they must be recognized. Whatever estimation techniques you apply, they should be valued. Now, as I mentioned that the goodwill would freeze on combination, there is obviously it is very, very difficult to determine the amount of goodwill as at the date of combination, and just don't touch it in future, because a lot of times you get to acquire more information about certain asset liabilities or certain other conditions or conditionalities in the combination. So the standard has given obviously a mechanism for that. An adjustment period for the finalization of acquisition accounting ends on the earlier of 12 months or acquirer has gathered all the necessary information. What it essentially means is that let's say I'm transferring control on January 1st, 2009, and as at that date, I would do the acquisition accounting. I would determine all the fair values, assets, liabilities, contingent considerations, earns outs, anything else, indemnities, if there are, would be valued. And I would determine the amount of goodwill. I would recognize that on my balance sheet. And that would be a provisional value, a provisional valuation. And subsequent to January 1st, if there more information available, there could be some new items coming up, which is very unlikely, but there could be some information which would give me some more basis to reassess the valuation which I did. So if there are, substantial amounts highlighted, then I have a window of time available until December 31st, 2009. The window gets closed in 12 months period. So if there is any provisional adjustment required, it can only be applied during that period. After that, I can't change any values. And whatever valuation I had done on January 1st, if it is on a different date, for example, the combination date is July 1st, and I have to close year end in December, so I will use those provisional figures. Until June 30th next year, I have option to reassess things, and only when there is a new information and extra information is available. So if that happens, I will finalize the figure before June 30th next year, and then I will restate all the figures, which were obviously provisional figures. So I will make appropriate disclosures in the accounts that these are the reasons for restatement. There's no exemption from 12 months rule for deferred tax assets or changes in the amount of contingent consideration. So everything has to be finalized within 12 months. Accounting for indemnity given by the seller. So a lot of times in the combinations, seller gives indemnities also. That if something goes bad, I will pay you and things like that. So the indemnity is recognized as an asset of the acquiring business. Previously, we used to ignore these indemnities because it was difficult to put up value tag to these indemnities. At times, these are very subjective indemnities. But now the standard is very clear that we must put a value tag to these indemnities. And whatever is the value, it should be recognized as an asset. It is measured in the same way as the indemnified liability, and it is limited to the amount of the indemnified liability. So if the indemnity is in respect of a liability which is recorded at fair value, then this indemnity would be also follow fair value model. If that liability is another value, a historical value, for example, there are certain exceptions, as I said. So this asset would also follow that model. So it can't be different from, like this indemnity is for some liability. So if that liability is recorded at using certain parameters, then the indemnity would be valued according to the same model. It can't be different. Issues indemnities given by seller. Indemnified contingent liability at fair value, indemnification asset recognized on same basis at acquisition date, and subsequently may reduce income statement volatility. So because previously these indemnities were not recognized, if I may call it this, these were off balance sheet. So whenever the indemnity was called, it would appear as a windfall income. Now it would obviously reduce that volatility, and when I would have recorded it at the business combination date itself, so it's only the differential which would come into the future P&L. Assessment of contracts. Now all the contracts have to be reassessed at the date of combination. For example, hedging embedded derivatives should be assessed at acquisition date and reclassified if required. So it is possible that the entity which was an independent entity, it had designated some contracts as hedging instruments. It had some other classifications, AFS securities, for example, or trading securities. Now, at the date of combination, the new business management might have a different perspective for those assets, and they might want to change those classifications. So it is available. They can change the classification. It's not that if it was a hedging relationship, so you can't break that relationship. You can break that relationship at the date of combination, but you can't, once you redetermine, you can't change that. Only exceptions are leases and insurance contracts classified based on conditions when incepted. Now, leases, when they were entered into, if they were classified, for example, finance lease, you can't change it today. So they will still continue as finance lease. Or if they were classified as operating lease, they will continue as same as for insurance contracts. If there is a judgment involved, that judgment would be applied at the date of inception of that contract, not at the date of combination. Now, deferred tax accounting is a bit tricky. Deferred tax asset may be recognized. Okay, first I will read through this third bullet here. Changes to deferred tax balances after acquisition date affect income or equity as normal and industrial. So usually everything goes normal, deferred tax and tax, there are no problems. But there are only two conditions here. Deferred tax asset may be recognized on combination if it gives rise to timing differences. The asset would be adjusted against goodwill. This was an exception, as I said in the beginning, that goodwill cannot be touched once it is frozen. You can't touch it. But if there is a reversal of this asset, which is recognized at the time of combination, deferred tax asset, if it reverses in future, the second leg will go into goodwill. So goodwill would be affected. Now, what it means is that when you acquire asset and liabilities and there's a whole new business coming in, you would reassess the timing differences at that point in time. So there could be some, for example, there could be some tax losses available into that entity, which might be available to you also. So if that is the case, you would like to recognize a deferred tax asset. So that deferred tax asset is what essentially it means. It's not only the tax losses, there can be many other timing differences which you would have to calculate at the date of combination and assess their tax and then the fair values as we are valuing them, compare with their tax basis and see if there are timing differences arising, you would like to recognize them. So those deferred tax assets are referred to here. And those would go against the goodwill amount. Essentially, it would reduce, the deferred tax asset would reduce the amount of goodwill. Now, conversely, deferred tax liability is prohibited to be recognized against goodwill. It is very contrast here. You cannot recognize a deferred tax liability on goodwill itself. So if there could be an argument that I am recognizing in this whole combination, I'm recognizing a goodwill and asset, so I should recognize a deferred tax liability on that also. No, that is prohibited. Resultant subsequent impairment shall also not affect deferred tax balances. So if there are future impairments of this goodwill, these will have no implications on your deferred tax charges. I hope you understand what I mean here. Like, if I have a goodwill on which I never recognize a deferred tax liability, in future years, I would impair it also, as we all know. So in, let's say, 2 years, 3 years time, I impair that goodwill. That impairment charge would not affect my deferred tax charge of that year, because there is no timing difference there. Changes in ownership interest. Non-controlling interest is equity contributor to entity. Recognized in equity, there's no change. Purchases from NCI in equity, so there's no separate goodwill on that. So if I acquire, if I have 80% holding, if I acquire another 10% holding, there's no goodwill. Sales to NCI in equity, there's no gain, because this is not a transaction which attracts income for the company. If there is a sale and purchase between the two shareholders, it is actually out of the P&L transaction. It will go only in equity, statement of equity. Loss of control is remeasurement event, and again would be recognized. Now this is very important. Like if I have 80% holding and I suddenly sell my 40% or 35%, whatever percent holding out of that, to lose the control, this would trigger the loss of control, and I would have to book a gain or loss. Like I'll remeasure all those values as at that date. If there is appreciation in the fair value, I would book a gain on my disposal transaction. So this becomes essentially the disposal of the control. No loss of control. Purchase of or sale to NCI after a business combination. Purchase difference between cash paid and NCI recorded in equity. Now, based on this model which we are following here, if I have valued everything at fair value, the whole business is valued, and then I have NCI, which is a part of it, and majority stake is with the holding company. The NCI is actually, it should be the fair value. It should reflect the fair value of the interest held by the minority. So if I have 80% share and the value of that 80% is 80 rupees, the fair value, and the NCI is 20% share and the fair value is 20 rupees for them, it is not necessary that the minority interest which is holding that share actually can fetch 20 rupees out of that interest. The valuation which is given by me in my balance sheet could be different from the valuation which the minority interest would be giving in their balance sheets. I hope you don't get confused, because those minority interests could be investors also. Those could be holding those investments on their balance sheets, obviously. So there they will be valuing their investments in this company as an could be more than 10% as an associate or less than that. So their valuation could be different from my valuation because I have taken into account many other aspects. The goodwill is there and the control is there, so I have given a proper valuation. So in a future date, if I want to acquire, let's say, another 20% from the minority, it may not give them 20 rupees. That's what I mean. I might buy their stake for 15 rupees at a discount, or I might get a good bargain and deep discount, 10 rupees. So that difference of 10 rupees would obviously not go to P&L, would settle in equity. I hope it's clear. Debit greater where partial goodwill recorded. Sale of shares to NCI, difference between cash received and NCI recorded in equity. So these, in case of partial goodwill, whatever amount is greater, the difference between the cash I'm giving and the value given, or the goodwill difference itself, because I had given some goodwill to the NCI itself when I was valuing. So whichever is greater would go to this equity. Issue sale of controlling interest and subsidiary interest or financial assets retained. Retained interest recognized at fair value. Gain on sale includes gain on remeasuring retained interest. So as I said that if I retain some interest, sale of controlling interest, so I sold the controlling interest, but I still retained some interest, so that some interest would be valued at fair value. Other issues. Before the acquisition, explaining the acquisition to investors, obviously this is required. We know that the company is going into acquisitions and make it a case. The financial statements will look different now. The effect of income on income statement in period of acquisition, how payment structure will affect income statement subsequently, how assets and liabilities recognized will affect income statement subsequently. Then valuations expertise are involved here in this model. Then after the acquisition, there has to be a monitoring and measurement of contingent consideration, finalizing fair values, which is 12 months period, and then indemnified liabilities. So this model is important that in the sense that we need to keep monitoring and measuring these elements in future dates also. So until the contingent consideration is completely paid off, it has to be remeasured. And similarly for indemnified liabilities. Summary, it was, as I said, first IFRS. There more fair value measurement, more income statement volatility at the date of acquisition and after acquisition. Economic entity model now embedded. Financial statements will look different. Be ready to explain. So this was IFRS 3. If there are questions, which I'm sure there could be some, please. As at what date? Okay.
Because of the remeasurement of the fair values and the already existing investments, what we have to settle that and all these things. So is it reasonable that the business is not actually earning this in income, and we are recognizing this as income in the P&L?
Okay, I'll give you a good explanation on that. This gain, which is realized on the initial, like in my example, I had an investment up to 10% in a company, and now I acquire another 50%. So now my interest goes up to 60%. Okay, so as at that date, the control transfers to me. Now the 10% stake which was previously held has to be treated as a disposal under the standard, and a gain has to be booked in that. Normally it should be a gain, although the standards says that it could be a loss, but rarely it should. Usually it should be a gain. Now the standard has re-emphasized on this point of booking that gain, and it tells you to go back and check all the assumptions and check all the fair values again. And it could be a case of actually managing your earnings in 1 year at the cost of your future earnings, that you give high values to those assets which you are acquiring, so that the older stake turns into a huge gain. You getting my point? So what the standard requires is that you go back and you double check all the assessments, all the valuations, why there is such a huge gain. And if anything needs to be rectified, please do that. What is obviously not acceptable is that you give too high a value to your assets, which are net assets which you are acquiring, in order to book a gain on your stake, which is being treated as a disposal. So that goes into P&L, and you can definitely try to maneuver that. So that I hope I answered that. But the idea is that it's a major event when you're acquiring a business. It's a great event. Um, it should be taken as an independent event. Whatever previous interest you had in that company had to be closed first. If you had equity interest, as I explained now, if you had agency relationships with them, if you had, like it's very common that you go and acquire an agent. So if you had an old agency relationship, you must close that. If you had any patents issued to them, you must close them. So, and whatever gains, losses accrue on that should be booked, so that there is a rebirth of a new venture, and then you start going. Yeah.
And then you said that a couple of times that the goodwill has now been freezed. Okay, but there are many exceptions, including the valuation of the share options, which will be given to the management, and the deferred tax, and so
no, valuation of share options will not affect goodwill. The only exception is deferred tax. There is no other exception. And if you may call it an exception, impairment. Obviously, if you recognize impairment, the amount of goodwill will go down in the future years. So that you can, if you may call it an exception. Otherwise, goodwill cannot be changed in future years.
Because see that what we have learned that there is a gap, or that the acquisition transactions require sometimes to determine the value. Okay, there are some transactions that they provide that say we will determine this amount after, say, suppose 6 months or 7 months, depending on the performance or the performance of the market or some other variables. So it's normal that the price of the acquisition is not determined on the spot, but the acquisition has been done. So will it affect the goodwill or not?
Well, that's why the 12 months period is there. But again, usually it is very much known to the parties what actually they are paying for and how much goodwill they are paying it in this transaction. So the goodwill amount, the idea is that you should not just make it a yo-yo amount. Like you book goodwill today, you start charging off assets against that goodwill in future years. Like in previously, we had many provisions whereby goodwill could be offset against other items. So that option has been eliminated.
How would you handle the changes in the tax law with regard to availability or otherwise of the losses of the entity being acquired in the time window that is available to you? During the time window.
If I understand correctly, what you mean is that in Pakistan, under the tax law, you can, if you continue doing the same business for, there's no new investment and all.
If there are changes during the time window, then how would you handle those changes?
If there are new enactments.
Yeah. During the time window.
Right.
If there are changes, then how would you handle those?
If there are new enactments post-combination, these would be treated as a subsequent event. So it would not affect the values. But if there are enactments before the control is transferred, yes, it would change the value of goodwill. So any practical issues or from your own experience, would you highlight some aspect which would have implications in Pakistan context?
Excuse me, you haven't talked about the commitments. Commitments, yeah. You've talked about the indemnities and contingents, off-balance sheet, all those things. Are commitments also fair valued and?
The commitments for balance sheet items doesn't affect anything. But if there are commitments in in the nature of contingent, rather the liabilities, the warranties, as we discussed. If you are referring to those commitments, like if a balance is not paid by a debtor, the seller will pay to the company. So those indemnities and warranties have to be valued depending on the likelihood of that event. Now, this fair value model exceptions, as I mentioned, there are deferred tax and there are other pension liabilities can be different from fair value. There is another exception, and that is IS 37 liabilities. And what it means is that at the date of combination, if the buyer and seller agree that there are contingent liabilities existing and they agree to make a provision for that, although they do not qualify to be provided for under IS 37, because IS 37 requires provision only when it is probable, amount is estimable, and things like that. Even if it is not meeting IS 37 criteria, but if they agree that some contingency should be built in, it is allowed to be built in. So that should not be, IS 37 would not be applicable on those provisions. So those provisions can be incorporated into the valuation. And same for the reverse indemnities and warranties. If those are available, those should be valued, and whatever is the likelihood, you give a price, you give a value tag. Let's say if there is a portfolio of debtors of 100 million, and the seller is indemnifying the whole portfolio, that if anything goes bad in that, I'll pay you 100 million rupees. Now, obviously, you don't value 100 million rupees as an asset as of today, because you know there would be only some amount going bad. It would not be the whole portfolio going bad. So it depends on their experience, your experience, the estimations. So you might want to book an asset of up to maybe 5%, depending on the history, 10% of that 100 million. So you book that as an asset in the valuation, and that would obviously decrease the amount of goodwill, because the remainder is the goodwill. And in the future date, if the actual amount of warranty, like the bad debt goes beyond that amount, let's say 20 million, you receive 20 million, and that difference will go to P&L. That is the idea.
Fahim, my question actually pertains to, I think this is the first session of question answer, to the borrowing cost.
Yes, go ahead.
Can
please.
I suppose there are two parties, different investors. They are setting up cement plants or whatever viable projects they have in Pakistan or in chemical. And the total construction installed cost, basic, of these projects is
the same.
1 billion rupees in each case.
Same, yes.
Provided things are coming from the same party or same country and same sort of thing. But one party have their capital or cash resources, and they probably 100% or 90% is funded from their internal sources, and 10% is borrowing.
Yes.
The other party has only 10 or 20% cash, and the rest is on 8/20 basis is funded and borrowing. So the party with more borrowing cost has naturally higher total installed cost plus the borrowing cost to capitalize, and the other party has less borrowing cost to capitalize. So one eventually, including the borrowing cost, one project with less borrowing cost eventually costs you 1.1 billion. The other party capitalizes it, say, 1.6 billion. So when you come to then a fair value at some stage, would you then reduce the 1.6 billion to say 1.1 billion to say that this is actually it should be the fair value?
Okay.
Because there are two equivalent plants, same capacity, everything, and probably it's only the funding source which is different.
Right. Okay. Obviously, it's a judgment. It's a matter of judgment as to what is the fair value of that plant. Is it 1.1 billion or 1.6 billion? And in case if we do not have any other valuation techniques available, then we will probably like to apply some discounted cash flow model, or because in case of plant valuation, I have practically used various other models. For example, the historical cost plus the dollar rupee depreciation model, or the replacement cost model. If I imported it today, what is going to be the price for the technological differences that being adjusted and things like that. And there can be a futuristic model, which is based on discounted cash flow model. So the fair value when model applied would not look at the values of these plants independently as 1.1 billion or 1.6 billion. Value arises at, let's say, 1.3 billion, so that would be applicable. But yes, sorry.
And the fair value 1.3 billion, he will not be able to put up the cost at the balance sheet. He cannot recognize a gain, can he?
Well, this is an unrealized gain. This is the surplus.
Okay.
And then if it is obviously an operating asset, then the surplus would reside in the statement of other comprehensive income.
Okay.
Yeah.
Thanks.
Okay, there is if there are other questions, please go ahead. Otherwise, there is a very good handout at the end of this. Handout 4. It's a very good handout, and we must quickly run through it. Okay, in here in slides, I have broken it into 3. Otherwise, it's a one-pager, so you can refer to your sheets there. First, it actually sums up the whole standard here. First, we need to understand the economics of the combination. What does the acquirer think it is buying? How much does it think it is paying? What does the contract actually say? Are there any other linked transactions? Is the transaction acquisition of an asset or a business? That has to be determined at the outset. If it is an asset acquisition, then we just group those assets, or if there are individual assets, then value them and apply different model. If it is a business combination, then we need to see what constitutes control, definition of control, then factors